Every profitable trader has one thing in common. They tested their strategy first. And that process is called backtesting. It's the safest and the most effective way to find out if your system actually works without losing your capital. In this video, I'll explain what backtesting is, why it's one of the most important steps in your trading journey, and how you can start doing it yourself. By the end of this video, you'll know exactly how to test your strategy safely before risking a single dollar in the market. Hi, my name is Matthew and this is Focus Charts. But before we get into the how, let's start with the basics. What backtesting actually is. Backtesting is simply testing your trading strategy on historical market data. Instead of risking real money, you go back in time, look at past price movements and apply your rules as if you were trading live. And you may be asking, how can you do that? There are dedicated backtesting software tools, and even TradingView has a replay mode that lets you go back in time and test your setups. Personally, I wouldn't really recommend it for serious backtesting. It's fine to try it out, but it has its limits. I've been using FX Replay through my whole trading journey, and I'm still using it today. It's simple, reliable, and does exactly what I need. Of course, there are plenty of other tools out there, some with more features or different interfaces. FX Replay has always been my go-to, and I've never had a reason to switch. The point of backtesting is to see if your idea has logic, if it could have worked in the past, and most importantly, if it makes sense to develop it further. Think of it like practicing a sport. You wouldn't walk straight into a championship game without ever training, right? Backtesting is that training ground. It's where you test your edge safely, make mistakes and learn, without paying for those lessons with your account balance. So why is backtesting so important? First of all, it saves you money. If your strategy doesn't work on historical data, it definitely won't work in a live market. Better to find it out in a backtest than after losing your hard-earned capital. Second, it builds confidence. Every trader will go through losing streaks. That's normal. But if you've already backtested your strategy and seen that it can survive those periods, you'll trust it more and you won't abandon it after just a few losing trades. Third, backtesting helps you improve your system. By tracking your results, you can see patterns, find weaknesses and make adjustments before going live. And finally, it builds discipline. Backtesting forces you to follow your rules trade after trade without skipping the boring or losing setups. The same discipline is exactly what you'll need in real trading. Alright. Now that you know why backtesting matters, let's talk about how to actually do it. The very first principle of backtesting is simple. You need to actually have something to test. That means you already have a defined strategy, a set of rules you'd like to trade in the real market, or at least a clear concept you want to explore. It could be something basic like support and resistance. If you don't have a strategy yet, don't worry, there will be a dedicated video on this channel where I'll show you exactly how to build one. But the bottom line is this: without a clear idea or a set of rules, there's nothing meaningful to backtest. Once you know what strategy or concept you want to test, the next step is to define your rules with absolute clarity. It's not enough to just say, I'm going to trade support and resistance. You need to know how you're going to trade them. Are you testing breakouts above resistance? Or are you trading reversals, expecting the level to hold? You must stick to those rules strictly. Don't bend them just because a setup looks good, or because you think this time might be different. If you do, your backtest won't show the real performance of your strategy. It will only show your bias, and that completely defeats the purpose of backtesting. If you already have all these rules defined, then it's safe to assume you also know which market you want to trade and on what time frame. In your backtesting software, you simply select the asset and the historical period you want to test. For example, I usually backtest 1 week at a time. That means I start on January 1st of a historical year, test 1 week and then move on. 1 week equals 1 backtesting session. But of course, you can structure it however feels comfortable for you. In one of the upcoming videos, we'll dive deep into FX Replay, where I'll show you exactly how to set up your strategy, create checklists, journal your trades and build your session step by step. In this video though, I want to keep things more on the fear theoretical side. So you first understand the principles behind backtesting before jumping into the tool itself. One of the great things about backtesting is that it helps you memorize exactly what your entry models should look like. But here's the catch: just because a few trades worked out doesn't mean your strategy is actually solid. Real confidence doesn't come from a couple of winners. It comes from the data, from knowing what your historical win rate is, how your strategy performs over time, and whether it can survive losing streaks. That's why it's generally recommended to backtest at least 100 trades with one strategy before you draw any serious conclusions. The more trades and the more market conditions you test, the more reliable your result will be. At the end of the day, backtesting and trading is all about statistics. The bigger your sample size, the stronger your confidence in the numbers. What to track? When you're backtesting, it's not enough to just mark wins and losses. To really understand your strategy, you need to track a few key metrics. Win rate, the percentage of trades that ended as winners. It tells you how often your setups work out, but by itself it's not enough. A strategy with a 40% win rate can still be profitable if the winners are much bigger than the losers. Risk to reward ratio. This shows you how much you're risking compared to how much you're aiming to gain. For example, if you risk $100 to make $300, that's a 1 to 3 risk to reward ratio. Combined with win rate, this number tells you if your system really makes sense long term. I already talked more about win rate and risk to reward ratio in my video about risk management. So if you haven't seen that one yet, definitely check it out. It will give you a much clearer picture of why these metrics are so important. Now let's move on. Profit factor. This is the ratio of your gross profit to your gross losses. If your profit factor is above 1, it means your system is profitable overall. The higher, the better. Maximum drawdown. This tells you how much your account went down during the worst losing streak. It's a measure of risk and a reality check of whether you'd be able to handle those losses emotionally. Notes and observation. Don't underestimate this. Write down why a trade worked, why it failed, or if you notice patterns you didn't expect. Sometimes these insights are even more valuable than the raw numbers. By tracking all of this, you'll build a clear picture of your strategy. Not just if it works, but also how it behaves in different conditions. And the good news is, you don't have to calculate all these metrics manually. Most backtesting software already tracks things like win rate, risk to reward, profit factor, and even drawdown for you. That way you can focus more on following your rules and learning from the results instead of wasting time crunching numbers. Limitations of backtesting. Now, before you get too excited, it's important to understand that backtesting isn't perfect. First, history never repeats itself exactly. Markets change, conditions evolve, and what worked 5 years ago might not work today. Backtesting can show you if your idea had potential, but it can't guarantee future results. Second, psychology. When you're backtesting, there's no real money on the line. That means no fear, no greed, no emotions. But in live trading, emotions are often the hardest part to manage. A strategy that looks great on paper can feel very different once you're risking real capital. Third, overfitting. This happens when you adjust your rules too much just to fit past data. Sure, your backtest might look amazing, but in reality, you've just tuned your system to the past instead of building something that can handle the future. So yes, backtesting is incredibly valuable, but it's only one piece of the puzzle. That's why once you finished your backtest, the next step should be moving on to forward testing. That means applying your strategy in real time on live charts, but without risking real money yet. Most platforms allow you to trade in demo mode, so you can see how your system performs under current market conditions. Forward testing is crucial because it adds the psychological element that backtesting can't give you. You'll start feeling the pressure of waiting for setups, the temptation to take trades outside your rules, and you'll learn how to deal with emotions in real time. Once your strategy shows consistent results in forward testing, the next step is to go live. But carefully. Start small, maybe risking less than 1% of your account, and gradually scale up as you gain confidence and prove that your system works not only in theory theory but also in practice. Remember, backtesting builds the foundation, forward testing builds your confidence, and live trading, that's where everything comes together. Step by step, this process is how you turn an idea into a profitable trading system. A quick tip: quality over quantity. I've heard many times that backtesting should become a daily routine, that you should spend hours on it every single day. And yes, the more you backtest, the faster you'll sharpen your skills and gather valuable data. That part is true. But here's something just as important. Your backtesting results are only as good as your focus. If you're forcing yourself to backtest just to tick a box when you're tired, distracted, or simply not in the mood, your results won't be accurate. You will rush through trades, overlook details, and the data you collect won't reflect reality. Think of it like live trading. You wouldn't place trades if you're in a bad mood, stressed, or emotionally affected by something, right? The same applies to backtesting. For me, it's always quality over quantity. It's far better to run a shorter, highly focused backtesting session than to push through hours of unfocused work that won't actually help you improve. So let's wrap this up. Backtesting is not just some boring exercise. It's the bridge between theory and real trading. It gives you confidence, it gives you hard data, and it shows you whether your strategy actually works before you ever risk $1 in the live market. If you take anything from this video, let it be this: have a strategy or at least a concept to test. Define clear rules and stick to them. Be consistent and track your results. And focus on quality over quantity. If you do this, you'll not only learn your strategy inside out, but you'll also start building the discipline and confidence every trader needs to succeed. In the next video, we'll dive into a practical tutorial where I'll show you exactly how I use FX Replay for my backtesting. Setting up sessions, creating checklists, journaling trades, and everything else step by step. If you found this video helpful, leave a like, share it with a trader friend, and let me know in the comments, have you already tried backtesting, or is this the first time you've really thought about it? And don't forget to subscribe so you don't miss the upcoming tutorials. Thanks for watching and stay focused on charts.